Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka.
And I'm Yatin Mota.
Well, the Friday fireworks were clearly missing from the Lal Street, given the fact that the Sensex managed to hit a record high this week. But nevertheless, we have ended the week on a negative note, and the Nifty, in fact, had a 100-point fall in today's session. The Sensex was also down somewhere around 300 points or thereabouts. And you know what contributed to the losses were, of course, the metal basket. That's index was down somewhere around 2.5%. You had the PSU banking and IT pockets that were among the top laggards in today's session. But there were a few gainers that managed to hog the limelight in today's session, like IndusInd Bank. That stock gained somewhere around 3% or thereabouts. Dr. Reddy's was another one that managed to hold out in a weak market. Bharti Airtel Asian Paints on the back of a crude cool-off, and NTPC was the other one that was gaining in today's session. Among the losers, Adani Twins, Adani Ports, Adani Enterprises, hefty losses coming in there. BPCL ahead of board meet on fundraise, and Hindalco, Divi's, HDFC Life were among some of the top losers when it comes to the frontline indices. But when you look at the broader markets, mid and small caps were once again underperforming the benchmarks. For a second day running, the Nifty mid cap index has ended lower by about 1% or thereabouts. Yatin, what were the movers and shakers there?
So, if you look at the mid cap index after a bull rally, or rather fantabulous momentum, despite the market weakness this week was broken. In fact, today the advance decline ratio first time after many days was almost 1:4, wherein one stock was gaining and 4 stocks declining. And if you look at the mid cap indices, they fell by nearly more than 1.5%. If you look at the movers today, ICICI Securities, and they have done a lot of these block deals, bulk deals, and good volumes has been seen on the desks. Probably because of that, this brokerage stock was up 7%. We also have the likes of MapMyIndia, Vijaya Diagnostics moving in trade. But if you look at the losers, clearly Adani Group shares were in focus after there is a talk that the US regulator SEC would be probing the Hindenburg allegations, and they have been in touch with several institutional investors as per the Bloomberg report. Obviously, the Adani Group has refuted, and they say that they follow the highest standard of corporate governance and they are not aware of such investigations. Nevertheless, Adani Enterprises, the shares were down 7%, Adani Transmission down 6%, and also we had the likes of defense companies witnessing some profit taking after the historic defense deal in the US. We had BDL down 6%, HL down 6%, Midhani, and a whole host of these PSU defense companies witness some profit taking in trade. So overall, today we had shares in the defense space and the Adani space in the mid cap space, wherein we saw some high amount of profit taking.
Well, high amount of profit taking in the defense space and some of the mid cap names as well. But let's also talk about some of the stocks that are on our radar this afternoon, starting with the IT stocks. Of course, yesterday Accenture reported its numbers post market hours, and numbers were pretty okay, but it was the guidance that disappointed. It has trimmed its upper end of the guidance, from 8 to 10%, it has come down to 8 to 9%, and that is something that came as a big disappointment for the Indian IT pack as well. Most of the IT stocks were in the red, barring the HCL Tech. That stock has in fact managed to outperform its larger peers. But when you look at what the brokerages have to say, they are pretty cautious. They believe that the commentary that has come in from Accenture around demand as well as discretionary spend and slowdown in the discretionary spend is pretty disappointing, and that slowdown may persist in the second quarter as well for some of these Indian companies. Morgan Stanley has said that you can actually look at accumulating some stocks on potential correction over the coming months, but most of the analyst community is divided. Some of them believe that even though IT stocks have come close to long-term averages, they haven't really fallen below the long-term averages, right? So once they do that, once some bit of more correction comes in, that could be a good time to look at some of the IT stocks. That's what the analyst community believes. But everybody says that you have to be a little more selective when you look at some of these IT names. So when you come to Nomura, it believes that Tech Mahindra and Coforge can be looked upon as buys, even though it is cautious on the IT sector. Jefferies believes believes that the risks to demand recovery in the second half may also lead to further PE derating for some of the frontline IT companies. Even JP Morgan is largely negative on the sector. It says that guidance implies, the Accenture guidance implies that there will be no growth recovery by the year end, and that would lead to, of course, a very weakness in the second quarter for Indian IT names. Yatin, contrarian views coming in on IT. A lot of analysts have turned underweight, but there are some people who believe that it's not, you cannot really time IT stocks, and one of them was Saurabh Mukherjee. We were talking to him earlier this week, and he said there could be great growth potential for some of the big IT names, given the fact that 70% of the Fortune 500 companies have still not migrated to cloud. So once they do that, there could be great growth potential for some of the IT names, and which is why he remains pretty constructive on the IT space. But of course, there are analysts who remain underweight on IT, given the
obviously,
fact that
there is some short-term pain in the
fears.
IT space, given the fact that the discretionary spends with the US and European clients has been a cause of concern. And in the short term, obviously, the clients which are doing discretionary spending in IT infrastructure would be curtailing back their expenses, given that there is a lot of uncertainty with respect to macros, especially for the US economy. Turning the tables from IT to auto, wherein there is some buying momentum. JP Morgan is overweight on Bajaj Auto with a target price of 5,400. Now the brokerage believes that the electric vehicle segment, with new launches, Bajaj Auto could grab some good market share, number one. Number two, the kind of new launches, especially in the Triumph premium segment motorcycle, would be a good opportunity to watch out for, because this is one product which will have a direct competitor like Royal Enfield. And if Triumph is able to make inroads in that premium segment, probably there is a lot to gain for Bajaj Auto. Also, if you look at the ramp up in the two-wheeler segment, EV volume ramp up, and the kind of margin profile Bajaj Auto has, this is one auto stock which has been outperforming and has been consistently delivering returns along with good dividends to its investors.
That's right, Yatin. In fact, the stock has done fairly well this year, and it had obviously earmarked 500 crore rupees or thereabouts towards its EV portfolio back in April. So we'll have to wait and see how this entire EV game plan pans out for Bajaj Auto. The other stock on my radar today is Voltas. Now this stock has been an underperformer. In fact, it has lost somewhere around 20% or thereabouts in the matter of a year. Now UBS has downgraded the stock to neutral and has cut the target price from 1200 rupees to 840 rupees. It believes that there are a few challenges galore for this company, given the fact that there is intense competition, and the company has also been losing market share to MNCs. And we had unseasonal rainfall in April, which dampened demand for the company and in turn dampened sales. But May did see some bit of recovery, but we'll have to see how the coming months pan out, because monsoons will start anytime soon. But when you look at UBS, it has cut its FY24, FY25 estimates, earnings estimates by 22 and 31%, and it believes that rising competition will pressure margins for Voltas going forward. And it believes that a profitable ramp up of its refrigerator and washer segment by FY26 may not really materialize. That's another risk for this company. And if you look at the trailing PE of this stock, Voltas, it is in excess of 150. Fairly expensive, given the fact that the sector PE is much lower than that. And stock, of course, as I mentioned, is down 20% in the last 1 year. And in the last quarter, FIIs have cut stake, but domestic mutual funds had increased their stake in the counter. But looks like the going is pretty tough for Voltas, given the fact that there is rising competition, and whether changes that played truant and did not really materialize for increased sales for the company.
Yes, and if you look at the AC segment, there was expectation that because of El Nino, the summer would be harsh. I think barring a few days, few weeks, this time the summer was not as harsh as expected. Probably the booster to AC sales did not come in as expected. And also, if you look at the consumer durable data which has recently come, it indicates that there is some pressure in the marketplace with respect to demand. And obviously, Voltas has been struggling with old high cost inventories, failing to gain market share, and also the margin profile was under pressure in the last quarter earnings, wherein the stock fell by nearly 10-15% post the quarterly earnings. So obviously, Voltas again today, after this price cut by brokerages, has been down by nearly 4.5%.
Well, with that, I think we've come to the end of this edition of Closing Bell. Yatin, it wasn't really a very enthusing end to the week, but I hope you have a great weekend. to compensate for that. So it's a good buy from me and Yatin. If you have any comments, leave them in the comment section below. But for all your other news and updates, keep following Money Control. I'll be back with the markets on Monday morning. You guys have a great weekend.